This is all for a 40-year-old male, preferred plus health rating. So that's a good health rating. This is with Guardian. They're all an annual target amount of $50,000 each, with a funding duration of 10 years for number one, and then 16 years for number two. So you can think about it like a bucket size of 500,000 for the 10-year funding, which is basically 50,000 times 10. And then for number two, it's a 16-year funding duration, so 800,000. That's pretty much the maximum duration as far as the efficiency design for these. So that's one of the downfalls maybe to these designs, is that there's a limited time you can fund it. Looking at how these perform, I created this spreadsheet so that you can compare the numbers side by side. And for the year one, I have this percentage up here. That's year one liquidity. That's just so that you can know how early efficient it is, because a lot of us are just wanting to dump in money and then accessing it right away. So the higher percentage obviously is better for most of us. You are possibly giving up some of the projected long-term growth. Again, I emphasize projected because that's not necessarily guaranteed. But by having the early cash value is one of our main focuses. The yellows here are where the policy would break even. So that's the cash value equal to or greater than the outlet. And then I think on the illustrations themselves, 25 pages long, one area to look at is page 13. So I took these numbers. It's from this middle column. This is supplemental numeric report. So starting on page 13 of the illustration, but it has 3 columns: guaranteed, non-guaranteed current, non-guaranteed intermediate. So these numbers are based off the non-guaranteed current. So this is making the assumption that you'll receive a dividend of 5.75%, which is the current dividend. And guaranteed, so Guardian has the whole life. For this specific product, is the guaranteed gross interest rate of 3%. So this is the contractually worst case with the largest company expenses and receiving 0 dividends. Essentially, this is the projected numbers. And again, these are guaranteed. So one of the whole life's, and especially Guardian strength, is this guaranteed side of the policy. And then the non-guaranteed intermediate is the halfway point between the current dividend, which is 5.75 and 3%. It's the midway point with that, which would be 4.625 or somewhere around there. But this is the intermediate, so a more conservative dividend estimation. Again, granted, we are in a low dividend environment, so it's most likely that dividends will go up in the future or at least remain the same. So even though this is not guaranteed, it's probably pretty conservative. So looking at number one is the 50,000 10-year. I put the MEC limit also up here. So the actual MEC limit is 77,376. Number one is just kind of showing if you fund it 50,000 a year for 10 years straight, just a straight funding, total 500,000. Do keep in mind though that there is flexibility on, you don't have to dump in 50,000 all at once. It's really the sum of this base premium, so $45.46 plus this $542, which makes it $5,089 is what's due annually, and then $44,911 is unscheduled paid up addition. So that's flexible, optional. Again, you don't start earning until that lands on your policy, but it is flexible. Big bonus with Guardian is the flexibility on the PUAs. This is showing the straight funding 50,000. 1A shows what I would call front loading, because Guardian allows you to shove in up to your MEC limit in year one. So this really just, and I'll highlight it because it's red, but it basically shows you dumping in up to the MEC limit year one. So instead of 50,000, boosting it up to 77,376. What that does when compared to the previous one, liquidity of 87.95 year one, it boosts up to 91.33%, purely because this PUA portion is what that additional portion is tied to, and it has the least amount of fees. So it helps boost up that cash value early on. Then still breaking even at year 4 or so. And then 1B, I just wanted to show some of the flexibility that even though it's a 10-year funding duration, you don't have to fund it for all of those 10 years. What happens if you just front loaded it and then just put in a total for 5 years? So it's 277,000. What happens? The first 5 years will look the same exactly. And then the last 2 years, so years 6 and 7, there's still the premiums that are due. So that will come out of the cash value growth. But then we can do the reduced paid up at year 8, which basically makes the policy paid off earlier than in this case. And so it reduces the fees on that. But even though it's a 10-year design, you could just fund it for 5 years and have the policy still perform actually pretty nicely. And then for number 2, it's basically the $50,000 design, but it's a 16-year funding duration. So this one, I'll look at it as a bucket size of 800,000. Pretty similar year 1 liquidity, but because there's a little bit higher death benefit needed to support that, there's a little bit more fees. So you see a slight drop in liquidity, but you'll notice that the MEF limit is $102,000. So it's a higher amount. I'm still breaking even now at year 5. But what happens if you do the 2A and front load it, you also see, because it's a higher death benefit, the paid up additions rider schedule is slightly higher than the number 1. If you recall, the total about $5,089. Now this one is 53,000, almost 5,300, almost 5,400. But the MEF limit was actually 113,000. So this shows dumping in 113,000. And what happens, and you'll see the liquidity jump up even higher, so 93%. So that's actually pretty good. What you have available is 95% of these cash values because they're reserving the loan interest ahead of time. What you actually have is 95% of this, but still 93% liquidity, which is very good, pulls up the break-even point to year 4 in this case. And then similarly, 2B, I show what happens if you were to just, even though it's a 16-year funding duration, what happens if you just fund it for 5 years? So the same things, we're cutting it off, and it allows major flexibility and not having someone feel like they have to commit to the 16 years. The second one also it's all the exact same designs, but it's just that instead of receiving the dividend, which is the 5.75, it's actually receiving that 6.5% average index return. For Guardian, there's no fee to have that feature on, but if you utilize it, so in this case, in these illustrations, I show utilizing it 100%. That kicks in year 3. So the first 3 years, you're actually just receiving the normal dividend. Then from year 4 on, you start receiving the index return. So the numbers will look identical from the index to the dividend in the first couple years. It'll change from year 4 on because it's receiving the dividend, but it's receiving that 6.5% index return. There's a 2% fee to utilize that feature. So I would look at it as it's actually you're receiving a 4.5% return, that's why you'll actually see, even though I'm illustrating this at 6.5% index return, the numbers are less than the dividend return. But I wanted to just show that. So that's the second tab. It's all the same things, 50,000 for 10 years, front loading, cutting it off at 10 years or 5 years, and then the 16,000 design, cutting it off for 5 years and front loading. But take a look. I know these are long illustrations, but I wanted to get this out so that you can start playing around, and we'll touch bases and we can definitely brainstorm and collaborate. We're at Alani this weekend, so we're just hanging out here. All right, bye.